Welcome to the third installment of the Virginia Main Street training series, Switch to 6, focused on diverse funding and sustainable program operations. This webinar content is adapted from a half-day immersive workshop format. To support your virtual learning experience, please download the presentations handout packet from the virginiamainstreet.com Training Resources tab. During the webinar, the instructor will reference several illustrations found at the end of that handout. The Main Street program is housed in the Community Vitality Office at the Virginia Department of Housing and Community Development, which is committed to creating safe, affordable, and prosperous communities to live, work, and do business in Virginia. The Virginia Main Street program is a Main Street America coordinating program which helps to lead a powerful grassroots network consisting of over 40 coordinating programs in over 1,200 neighborhoods and communities across the country committed to creating high-quality places and to building stronger communities through preservation-based economic development. This training series is designed to prepare Main Street community professionals and volunteers for the Switch to 6 and provide an in-depth understanding of the new Main Street America community accreditation standards through real community examples from across the national network. This new evaluation framework is based on best practices for a successful Main Street program and sets a path for growth and development for newer programs. Annual program assessments are an important opportunity for local Main Street leaders to come together to reflect on the progress of a program's efforts and identify opportunities to build and grow. The 6 standards are broad-based community commitment, inclusive leadership and organizational capacity, diverse funding and sustainable program operations, strategy-driven programming, preservation-based economic development, and demonstrated impact and results. More details can be found in the mini video and community assessment tool hyperlinks in this slide deck. Information about past and upcoming trainings can be found on the Virginia Main Street blog. That's virginiamainstreet.com, where you can also learn about best practices, local stories, funding opportunities, and upcoming events. Sign up to receive posts in the bottom right-hand corner of the blog's landing page. The objective of this webinar is for you to understand Main Street program funding best practices, the diverse funding streams that are essential to a resilient revitalization effort, and work plan aligned budgeting. A successful revitalization program must have the financial resources necessary to carry out its work and sustain its operations. So Standard 3, Diverse Funding and Sustainable Program Operations, will help you to prioritize ensuring that the community is investing in the Main Street organization and programming efforts through a comprehensive and balanced funding structure that ensures successful and sustainable revitalization efforts. Our speaker is Jen Goldman of Jennifer E. Goldman, LLC. Jen helps nonprofit leaders learn new tools, achieve new goals, determine stronger methods of sustainability, and direct their organization onto a mission-driven path to success. Jen is a former Main Street Organization Executive Director and continues to harness her passion for Main Street by supporting startup and seasoned organizations. Thank you, Jennifer. Take it away.
So talking about the workshop now, we're going to dive in. I want to remind you, you'll need the handouts with you as we go through. That's going to make life a lot easier for you. Also, at the very end, you'll see my contact information. Please feel free to reach out to me if there's anything you need further explanation of or that you have a question about. I'm always happy to answer questions. So money matters. We're creating an upstanding downtown organization. And in this workshop, we're going to go through and hopefully give you a deeper understanding of how to create a funding structure with a diverse mix of public and private sources, incorporate program budgets into the funding plan, restrict single source reliance, foster organization-wide commitment to the fundraising process, and design policies for financial oversight. There's also going to be some spots in this workshop where we're going to be doing some small and large group discussions and activities. If you have your group with you, maybe you've got some of the folks in your organization there, maybe some board members, some volunteers or committee members. It'd be great if you wanted to stop the recording or pause the recording at that point and maybe do some of these exercises together as a group. That might really be helpful. So when we get to those spots, I'll let you know that we're in one, and I will explain to you what it is that we did in person, and hopefully you can go through that with some of the people in your own organization. So in person, I included this slide because I love hearing about all the people that are there in the room, getting a deeper understanding of who I'm talking to and what maybe their unique challenges are, what they're hoping to get out of the workshop. So I know because you're watching a recording here, the interaction is a bit limited. So like I said, at the very end, you'll see my contact information. I'd love to hear from you. If you were watching this recording, love to hear what questions you had, what challenges you might be going through, what you were hoping I would answer through this workshop, and whether I did or not. If I didn't, reach out and tell me something you were hoping to achieve through this workshop that didn't quite come through. And I'd be happy to work with you to make sure that you get what you need out of this. So when we're talking about budgeting and funding planning, I just like to make sure that everybody knows the difference between the two. Budgeting takes into account all spending and all income for a look at your bottom line. It's a way to ensure your organization has accounted for all of its spending and all of its funding, and nets out at the end of the year, hopefully in profits. So the picture on the left here, when we talk about budgeting, a lot of people have the word balance in their head, as if the two need to go side by side, which causes me a little grief, a little pain. Because a nonprofit organization is also a business, I never want to see a budget that nets out to zero, where all of your income adds up to one number and all of your expenses add up to one number, and those numbers are the same, so that you net out at zero. That's just bad for business. You can't grow that way. You can't be sustainable that way. So as much as it pains me to put a set of balancing scales there, I think this is what normally comes into people's minds when they think about budgeting. We're talking about all the income minus all of the expenses to find out what our net is at the bottom. So that's budgeting. And funding planning, although takes a more analytical look at the income side of it. And I equate this to a pie. So if we think about it, planning for Thanksgiving, I know it's months and months away, or months and months in the past, depending on when you're watching this. But if you think about your Thanksgiving Day pumpkin pie, you need to know how many people you're serving. You need to know how big that pie is going to be. You're going to need to know who's going to be responsible for how much. So when we're thinking about that pie, is who are we serving with it? What size slices is it? Maybe Aunt Jan is on a diet and she's just going to take a slim little taste of a piece of pie. Maybe you've got a couple of teenagers, so they want a fairly decent sized piece of pie. And then you've got Uncle Bob at the other end of the table, and it's basically like, whatever is left is mine. I'm claiming the whole whatever. And so we think about the funding planning like that. Where is your income coming from? How does it slice up? What is the size of it? How much money do we need? And where is it all coming from? Is it going to be a little bit from here and a lot from there? Is it going to be 20% from here and here and here and here and here? And so that is funding planning. And if you look at that pie, just think of that as money coming in. We're going to loosely look at where it's going, but really realistically, we want to be planning what's coming in and where it's coming from. So I think as we get further into it, the whole pie thing is going to take a better shape in your mind, no pun intended. But hopefully this makes sense to you. Budgeting, we're looking at balancing that. We're looking at income versus expenses. But with funding planning, we're really just looking at diving in and defining those slices of pie. What's coming in and where is it coming from? Okay, so here is where it's going to be handy for you to have the handouts. And the first handout is a sample variance report. It is an Excel spreadsheet. I'm going to see here if I can share that with you at the same time that I'm talking. handout packet. Here we go. So, okay. I won't be able to keep this up the whole time, but hopefully you have this sheet and it looks just like this, the sample variance report. And it is an Excel spreadsheet. And as we saw on the slide, you're going to have 3 columns. You're going to see, or 3 columns of numbers. You're going to see your budget. So what I advise everybody to do is, instead of going into the funding, into the fiscal year that you're in right now, because it's not complete, you won't have a full year set of numbers. So I advise going back to the last full year you have. So right now, like I said, we're doing this in person in May. So we're coming to the end of fiscal year 2023. So because that's not a complete year yet, I would say go back to your fiscal year 2022 numbers if you want to run your own variance report, because that'll give you a full 12 months. So we want to go in and we want to put in a column for the budget. Here's what was approved, what our budget was, what the board approved for our 12-month period of fiscal year 2022, or if you're seeing this later in 2023, you may already have your full 2023 numbers. You can use those. The budget obviously is a 12-month set of figures. And then next to it, the actual figures for the full fiscal year, and use the same fiscal year. So if your budget is for fiscal year 2022, use all the actual numbers for fiscal year 2022. And then the variance column, we want to see how those net out. How did we do? Did you bring in, or, this is also going to have expenses, even though we're talking more about the income side of this for the funding planning. How did you do? Where did you think that income was coming from? How much income was it? And how did your actual numbers net out compared to your budget? Now, when we get to this variance report, some people use dollars in that variance column. So we would see, let me think here, let me look at the columns here. So if we looked at the car show and it says we budgeted for $5,000 worth of income, and we see the actual is $5,642. Some people would have in the variance column $642 would be the difference between what we budgeted and what actually came in. I prefer to use percentages there because I think it gives, at least in my mind, a much more accurate picture of the difference. So, for example, if you see a variance there of $1,000, to me, that doesn't mean very much, because what you budgeted might have been 100,000 and you brought in 99,000. And so the variance is $1,000. That's not so significant. But if you budgeted for $2,000 and you brought in $1,000, that $1,000 variance is now hugely significant. So if you look at that, we would say, okay, we only brought in 50% of what we wanted, and that's the variance there. Whereas if it was, what did I say, 100,000 versus 99, what is that, 1%? So then, the significance there is shown more by percentages than in dollar figures. So I do recommend doing that. And what also needs to happen here, because you're not all by yourself, a Main Street program, hopefully you have your staff, you have your board, you have your committees. I would say at the very least, the people who are making more decisions about the money, maybe it's a finance or budget committee, maybe it's your executive committee and your executive director, whoever's going to be making those decisions, come up with what your comfort zone is. So sometimes we can get lost in the weeds and we can look at every variance that's above 0 or below 0. I would recommend coming up with your comfort zone. So where are you comfortable? What margin of error are you just going to say, you know what, that's okay, we're close enough? For some people, that variance is going to be anything over 5% we need to take a look at. For some people, it might be 10 or 15%. But don't look at every single number. You'll drive yourselves crazy. As you can see here, I marked everything that was a negative variance so that you can see. But do keep in mind, if you're going to be looking at the expenses, a negative variance means something very different. So when we're looking at our income, a negative variance, it means that we didn't bring in as much money as we expected to, or as much money as we had planned to. However, when we get to the expenses, the negative variance means we didn't spend as much money. So it's actually a more positive figure there. But what I like to do is look at the variances and decide, for me, I'd probably want to look at anything over 10%. Or everything under negative 10%, just because even if I didn't spend as much money, which is great. It also means I didn't plan as carefully as maybe I should have. So that's what this report is taking a look at. I know no matter how good you are, you're never going to see a variance report that's just zeros down the whole right-hand column there. So don't expect that. Perfection is not going to happen. So I want to go back and share with you the slideshow again. So, okay, hopefully you have that variance report in front of you. You don't need to see it on the screen anymore. And so as you can see here, we're looking at those budget figures. We want to know how we did. We're comparing the numbers on the sheet and trying to figure it out. And you may need other people than just your budget or finance committee to help you explain these things. So if we're looking at, say, for example, we go back to that variance report and you see under promotional events, it says Christmas. And we budgeted an income to come in from that Christmas event of $5,000, and in actual dollars, sorry, getting all twisted up here, we brought in 3259, which was a negative 35% in the variance report. So now we want to know why. Well, you might have to go back to your event committee, to explain this. And it's not about finger pointing. It's not about blaming. It's really just for understanding what happened so that we can plan and budget more carefully going forward and more accurately. Because what happens at the end of the day is when you're bringing in more or less income than you expect, and when you're spending more or less money than you thought you would, then you don't net out at the end of the year like you expected. And so then sometimes we fall short and all of a sudden bad things are happening. How are we going to make payroll? How are we going to pay the bills next month? Or we have more money than we want. And then all of a sudden there's money sitting in a bank that's not really doing much for us when we could have an investment somewhere. So we just want that planning to keep going. We want to be in a good place where the variances are very small, where we know exactly or pretty close what's coming in and what's going out so that we can plan for that growth, that sustainability, that increased capacity. And when your numbers don't line up, it's hard to plan ahead. So that's really what we're looking for. So if you have to bring in your event committee, like I said, don't be pointing fingers. Don't be like, well, why didn't we make this money? Where did it go? Did you steal it? It's not about that. It's about explaining it. Why didn't the numbers go the way we thought we would? Well, for Christmas, maybe it's an outside event and it snowed and the roads were icy and the event, part of it got canceled. And so you weren't able to bring in as much. Then, okay, we know weather is something we need to take into account. Is this consistent? Does this happen to us every year? Was this just a weird anomaly year? So we're looking at it that way as well. What factors were in play here that made the income not what we expected it to be? Maybe you made more money than you thought, and you still want to sit down with those people and find out why. Why did we make more money than we thought? Was this an anomaly? Was it something that we can count on so that maybe next year we should increase the budget for this? We should expect to be bringing in more income from this particular thing. Maybe there are things in this event we can leverage and take advantage of because we know it makes more money than we were expecting. So really that's what we're looking for, is figure out anything that's over and above that variance comfort zone that you defined for yourselves. Take a look at all those numbers so that you can then be looking forward. So if it's still fiscal year 2023 for you when you're watching this video and you're still planning your budget for 2024, how can we tighten up those numbers? How can we learn from these variances that stand out to us and plan our budget accordingly for the next fiscal year? So if I was taking a look at this full sheet here, I would say, okay, the car show made more money than we thought. So maybe there are things about the car show that we can leverage that maybe we planned for $5,000, but I see here we made closer to 6,000 than 5. Can we increase that budget and expect 6,000 again next year? Maybe there's something we can learn from the fact that we know, oh, this is a good show. It makes more money. Maybe historically it's always made more money than we expected. Can we raise that? Can we make it to 7,000, maybe 7,500? With Christmas, what is it there? What factored into such a big loss for us? Not a loss, but not bringing in what we expected to there. Is that something that's normal and we should lower our expectations of this event? Or, maybe, like I said, it was just an anomaly and we still think we can bring in 5,000. I see, EUS here under fundraising, and it made significantly less as well, 22%. When you look at the 35% at Christmas, that's still a whole lot less money, of a difference than in EUS here. That's a $16,000 less brought in than was expected. That's pretty significant. That's why? Why is that? What is happening with this event, with this fundraising effort that's not working? And how can we fix it so that we can not just budget better, but also figure out what it is we need to be doing for that fundraiser so that it can make it to the expectations that we have. And then you see miscellaneous events here. That one's hard to explain because I don't know what miscellaneous events is, but obviously it made more than was expected as well. So realistically, what we want to do here, when you go down to the total of income and you see there's a negative 11%, it means that between all of these different variances, we brought in 11% less income than we expected. Now, while 11% isn't hugely significant, that's a fair amount of loss now that we're looking at. That's 11% of our total budget. When I said at the beginning, you don't want to balance your budget, if we had planned for exactly $132,000 to come in and exactly $132,000 to come out, and suddenly we only have $116,000 worth of income, but we've planned to spend 132, that's a problem. Now we're operating at a loss. So we want to keep that from happening. So as I said, we don't want to go through every number. We want to pick those variances that are outside of our comfort zone and pick on those. If you do want to go through your expenses as well, definitely be looking at that. But what's important to me as we go down to the totals at the bottom, we budgeted $132,000 worth of income and almost $118,000 worth of expenses for a gross profit at the end of the year of $14,130. But because of all the variances, we brought in 11% less than we thought we would. And we have only 98% of the spending. So we did okay there. However, it netted out to a negative gross for the end of the year of $939. So as you can see here, we actually, while we thought we were going to have $14,000 left over for reserves, we're in the whole $900 here. So these are the things we're trying to prevent, because what hopefully would happen is we had plans for that $14,000, that it was going to go into some investment or go back into some other program for the organization. That now can't happen. Now we're scrambling to figure out where to get that extra almost $1,000 to cover our expenses from last year. And we're starting the next fiscal year at a loss. So hopefully when you go through this variance report with your own organization, you can take a look at these and help yourselves create a budget for the next fiscal year that's more accurate, more realistic to what you're going to find and experience throughout the year. Okay, hang on to that variance report. I think there's another spot in here. We're going to talk about it, but we're going to move forward and looking at budget forecasting. Like I said, as we go through that variance report, really what we're doing is we're taking a look backward and analyzing it so that we can plan and forecast for the future a little bit better. So adjust your current income streams to show more accurate expectation. You also want to add new income streams, anything that might be missing, but be careful thought to whether they're reasonable or not. How much can you expect from a brand new income stream, and who will be responsible for securing that income? So what you see in the slide are some general ideas of funding streams. Maybe something here will give you an idea of a new income stream your organization doesn't currently have, something that you could easily or reasonably add to your funding plan. So these are just some super easy, common income streams that nonprofit organizations have. Grants, it's nice, you can't always count on them. Obviously, if you have working relationships with grant funders and foundations and you know that you'll have that coming in, that's fantastic. But otherwise, you will want to identify some grant opportunities and make an application. It's money that I believe, unless you've already gotten a commitment from them going forward, it's income that you should hope for the best, but plan for the worst. Make sure that you know where money is coming from to cover what that grant was going to cover if you aren't approved for the grant. Local government funding, hopefully you're all getting money from your town and hopefully your county, especially if your downtown is part of the county seat, then in my mind, your county should be supporting you as well. Private contributions coming from families, citizens, events. I know a lot of organizations have events for fundraisers. Annual sponsorship or membership, I feel a little asterisk there because I always caution nonprofit organizations to call people who support them financially members, just because so many of you are 501c3s. And I believe it's either a 501c4 or 501c6 is actually a membership-based organization like your Chamber of Commerce. So that description of member really means something different if you're a membership organization. So if you are not a membership organization, I would strongly advise you, there's nothing legally wrong with calling somebody a member, but I find it a little bit confusing for people, and I would come up with other names like a friends or supporter or something of that. But you also have annual sponsorships. This is something I thought was more common than it actually is. It was something that I did when I was a Main Street manager. Our board members kept saying, you know, we're getting so tired of asking all the same people for money over and over and over again. Every time we have an event, we go to the same people because we know they say yes. And, you know, then every time we do a program, we go to the same people. So I created an annual sponsorship package, which was, let's go to our supporters once a year and say, okay, we have all these opportunities to support us. You can still go, you know, if there's one or two particular events or programs that you like more than everything else, you can still contribute individually, but you can give to us 1 year and here are the benefits to you. And so we created that annual sponsorship so that, I mean, we still could go back and ask them for more money, especially when we knew it was a program that they particularly enjoyed and loved and wanted to support. But otherwise it was, you know, a bigger sum of money, just, you know, a 1 year lump sum. And if you want, we'll leave you alone. Local civic organization donations. I don't know how many of you do this, but so many downtowns have many civic organizations in and around them. And there are great groups of people who are always looking for ways that they can serve their community. So they don't always give money, but they might find a way to help you fund a project. I know some of them for ours. I'm trying to think of some of the streetscape projects that we had. The local Rotary Club loved those types of projects. So while they wouldn't donate money to us to accomplish that, they would raise funds on their own. So let's say there were flower baskets. They might be the ones who raised the money to purchase the flower baskets, and then they would donate the flower baskets to us, or they would raise the funds for the flowers to go in the baskets, and then they would spend a day planting flowers in the baskets for us, things of that nature. So it did save us money. They were just donating in kind through their own fundraising efforts. Merchandise and online sales. A lot of us had swag back in the day. I'm sure you do too, maybe t-shirts and mugs, things like that, that you sell at your events, but maybe also online through your website. Community partnerships, these are great. I don't know how many of you take advantage of this. Usually through partnership, you're not getting money. Sometimes you are, depends on how that partnership is structured, but usually those partnerships create opportunities that will save you money on some of your projects and events through the other partners doing part of the work or doing part of the spending that you no longer have to do. And then special taxing district is your town, or maybe if you're not, I guess most of you are in a specified town, but otherwise perhaps your county sharing part of a tax revenue that they get that is based on the work that you're doing in your downtown. So there's a lot of other income streams here, and I urge you to take this list and blow it out of the water, add to it, brainstorm it, take it to all the other people in your organization. Which ones of these do we have? Which ones don't we have that maybe we want? What other out of the box ideas can we come up with? What other income could we be getting? You know, try to think of any way that you might be able to get funds. Obviously, the more money you can get through the least amount of effort is great because you want to be saving your time and your resources for working towards your mission. Okay, so next, in person, we are doing a small group exercise. So after I explain it here, if you have other people there with you, or maybe you just want to take some notes and do this later, you might want to do this in your organization. So what I did was sort of, I'm calling it the Secret Santa type of exercise. And so what I did is I put a bunch of income streams, each one on a separate slip of paper, and I threw them into a bowl, and I had each group pull out one slip of paper, one funding stream that their small group was going to talk about and brainstorm. So what you're going to do, if you just have one group of people, maybe if you get everybody together, maybe all of your board, all of your committees, you might be able to do small groups, and everybody gets to pick their own funding source. So for each group, they have one funding source. And in your group, what would you put into that funding stream? Where would you get the money? How would you get it? What are the best practices you can determine to make sure that this funding stream will be successful? And so what we did was we worked with this for 15, 20 minutes, sitting in small groups, about 4 or 5 people each, just each one talking about their own funding stream and how you can make that the most successful for your organization. What are the best practices? Like I said, who's going to be responsible for getting that money? How much money do you think? How can you leverage it? Any best practices and great ideas you have to make sure that that particular income stream would be successful for you. And then at the end of the 15 or 20 minutes for that exercise, one person to get in front of the group and share it with everybody else to talk about what their funding stream was and how they decided they could make that the most successful as possible. Now, obviously, the more people you have for this, the better, because you'll be brainstorming, and then you'll also get to explore more than one funding stream. So if you're just watching the recording, you might want to just take some notes, talk about this, maybe work with your group. If you have enough people, you might want to do the exercises, maybe just do one funding stream if it's just a small group. Or if you do have enough people, maybe you can break up into your own small groups and do this as well. So moving forward, I know I said funding planning is primarily about the income, but it's also helpful for you to understand the cost of your programming in order to successfully plan for your income. So organizations generally spend their time running programs. Whether you've labeled them this way or not, that's what they are, your programs. It's something that took a while for me to recognize when I was running a Main Street program, is that, so we had, for example, a Christmas event, and it happened every year. It made some money, but it wasn't a fundraiser. It was our organization's contribution to the community, our gift to the community at Christmas time. Something that was always going to be old fashioned, something that you could come and enjoy. And if you wanted to spend money, you could, but you didn't have to. There was nothing you had to buy, or pay for in order to be part of. And part of that was inside, and we had, basically it looked like a theater set. But it was a miniature version of our old town. And when you're standing in line to see Santa, you're looking at this miniature version of Old Town. But if you're one of the kids and you're going to go shopping in Santa's Secret Shop, you're on the back side of that. And on the flip side, they were basically shopping shelves of products and gifts and things that you could buy from Santa's Secret Shop. And over time, of course, that set got a little tired, a little sad, and realistically needed to be replaced. And we didn't really know how to replace it or how to pay for it, or even what to do. And I realized after a while, even though it's technically an event, that Christmas event is a program. It's something that we do over and over again for the benefit of our community. And if I had developed a program out of it, a well-written course of action for that thing, we could have probably explored funding through grant options. So this is something that I advise people to do. If your programs are well developed and in a written plan, they're much easier to fund. Developed programs can be easily shown to bankers, foundations, associations, local government, or other types of funders. I do have an entire course dedicated to this online, but as you're thinking about your funding, also be thinking about your plan development. How can we get more private funding or grants if our programs were in a written plan? Would these plans make it easier for a committee and board members to understand what we're doing? communicate it outside of the organization, and ask for funding. So as we talk about program development, and I know this part of it's a little off topic, but it's also a really great communication tool. So when you're looking for volunteers, when you're talking to board members and other stakeholders, and you can show them this well-developed program plan, it makes it a lot easier for them to understand what you're doing. So it's a really great communication tool for you to get your board members and committee members and other volunteers to understand what the plan is, how this program is being worked, maybe what their role is in it, but it also helps them communicate outside of the organization, which also leads to better funding options. All right, so discussion for the in-person groups, like how many of you have formal, well-written programs that are defined in a way that would allow you to apply for a grant tomorrow? So one of the things I know as a consultant, I'm usually asked is, do I do grant writing? And my typical response is, no, I do program development. Because what happens is organizations are looking for someone who can help them with what I'm going to call the pot of gold. You just found this great grant opportunity and the grant deadline is in 30 days or less, and you want someone to snap out some sort of grant application for you. The problem is when I start working with a group right then and there, we're already so far behind the 8 ball and there's so much work that has to be done. 30 days is not equal, and it's just not doable. But also, there usually isn't a formal written plan all ready to go. So I'm having to do so much research and homework to understand this organization and where they are. And there's no promise that this grant opportunity that's been identified is really one that they are aligned with. That they might get approved for. So what I like to do is help organizations, like, let's write that formal program, let's write that plan, let's figure out exactly what you do and how you do it and what type of funding you need. And then we can identify the funding sources and go after it. And at that point, if you have that well-written program plan already in hand, anybody can fill out the grant application because you already have all of that information right at your fingertips. All you have to do is sort of the plug and play thing. So I highly recommend it. It is a great funding tool, and it's not just for grants. It's a great funding tool for talking to your stakeholders. Like I said, it's a great way to communicate throughout your organization what's being done and how it's being done, and to get that funding from others, because the more they understand about what you're doing, the more likely they are to support you at an appropriate level. Okay, so as we're talking about grants, this also is applicable to other funding sources, though it most directly applies to grant funding. And I want to make sure that everybody knows the difference between direct and indirect costs. So a direct cost are expenses, or direct costs are expenses incurred specifically for the benefit of supporting one particular program, activity, or project. Indirect costs are expenses incurred for the benefit of multiple programs or for the overall success of the organization. So for example, if you were at the in-person Rev Up in May in either Fredericksburg, Alta Vista, or Bristol, you would have seen me. I am a direct cost. I was paid by Virginia Main Street to come and do the training in those 3 towns, and I am not a vital part of the Virginia Main Street program. They don't need me in order to run the program. The program doesn't need me, but that training session, it needed me. I was there for that training session, in particular, that one particular Rev Up activity. So I was a direct cost. Now, also at those Rev Ups were part of the Virginia Main Street staff. They are indirect costs, because while certainly the trainings would not have happened without them, they were essential for putting them together and for hosting. But they're also there for the overall success of the organization. Virginia Main Street itself doesn't run without them. So while they're vital to the program, they're also vital to the overall success of the organization. So that's the difference between direct and indirect. Now, there became greater flexibility through the pandemic from grant funders who realized there were so many organizations that when you take out and negate the executive director and the staff of a program for the sake of grant funding for that program, then all of a sudden they can't afford to do it. If you're not going to pay the overhead costs the administration and the staff and the payroll and, all the other things that we have in our overhead, if we have to take those costs out of funding this project and you're funding everything else and we're having budget problems, well, we can't afford to do this program then because we can't fund all of it. And we need our executive director and our office, and we need funds that aren't earmarked that way. So I think because of all of the financial trouble that was happening during the pandemic, a lot of grant funders became more flexible about that. Now, will they go back to the way it was? As the pandemic ebbs, I'm not so sure. They might stay that way and recognizing, what, you really can't take out the indirect costs and expect an organization to be able to fund everything else for these programs. So I don't know if they'll keep that or not, but it does affect how you do your funding planning. So assuming that some of your income might be earmarked, what you really need to know is, for example, if you have a project that includes, let's say it's $25,000 for the whole project, and it includes $20,000 of direct costs for that project to happen, and $5,000 for indirect costs, which includes, part of, you doing this project mostly in your office. So there's overhead and rent there. Your executive director is going to be keeping on top of it. So part of his or her salary goes into that. So we've got $20,000 of direct costs, and $5,000 of indirect costs for a $25,000 project. And you win a grant for $25,000. It seems like apples to apples there. You've covered all your costs. But if you look at the small print, in this particular grant will not allow you to cover indirect costs with that grant. Now you have a $25,000 program and a $25,000 grant, but you can only use it toward the first $20,000 of those program costs. So now you still have $5,000 that you need to get from somewhere else. So it's really careful to know that, because otherwise, like I said, at the end of the day, you're going to be caught a little bit with your pants down. You're thinking you've got $25,000 here and $25,000 there, and they equal out. But really what you have is a $25,000 project, and only $20,000 of it is going to be funded. So you do need to know that. As I said, we're talking mostly about the income, but it's really important to understand how you can allocate it, especially when there's definitions and requirements of some of the income. So you also may have what I said down here, earmarked funds. Some donors or partners may require funding that they contribute to be used only in a defined manner. So knowing which funding streams support which aspects of your organization is essential to ensure that you cover it all. So I don't know how many of you deal with earmarked funds. It's not super common with the exception of a few grant requirements, but sometimes we do. And I encourage people, when you have earmarked funds, definitely record them separately so that they're not just going into a general fund and you accidentally spend them in a way that you shouldn't, because some earmarked funds, especially when they come from grants, you will report back and you will need to show the trail of spending and recording that shows that income that you received from them was specifically spent the way that they said. So for me, I know we had a streetscape project one time, a design project, and we literally just opened a different bank account, made it all completely separate, didn't even put it into the same bank or the same bank account that we had. The accounting was separate just so that we knew exactly where it was and that it was separate. It would never be commingled with anything and mistakenly spent in a way that it shouldn't. So do know when you need to be careful like that. Excuse me. Okay. So now we need to start looking at the big picture, as we talk about different income streams and different monies and where they're going and how they're being spent. Sometimes we need to be down there on the ground looking at every inch of ground, and sometimes we need to be up in the sky looking at the big picture. So now we're looking at the big picture. And there's all types of, what am I trying to say here? Funding sheets, budget sheets, financial sheets, I guess is the word I'm looking for. That you can look at to see the big picture. So the balance sheet is one of the most common. It is a current snapshot of your financial position, position, accounts for all transactions from the beginning of time, shows your organization its net worth, and indicates how well or not your organization can pay its debts and liabilities. So the big picture look at your organization should help you shape your funding plan. Are you able to cover your current liabilities? Do you have positive cash flow? Does the organization have a positive net worth? Enough cash for a cushion? How long would your organization be able to sustain itself if another penny never walked in the door? So I'm not huge on balance sheets. I know they give us that snapshot there. I prefer looking at a profit and loss statement, but as you see, as we keep going, we're going to talk about some ratios that I think are more helpful. But a balance sheet is really common, and especially if you have somebody in your organization, like an accountant, that's probably much more useful to them than it is to the average person. But it is good if you have a head for that, which mine is not. This is definitely something that is looked at quite commonly. All right, so now that you have a better idea of the funding needed to carry out your mission over the next year or for the next few years, it's time to start defining, like back on the ground, the slices of pie and common funding sources. So as we talked about earlier, knowing what those slices of pie are, how big they are, like how many slices do you need and how big is each one going to be. So some of the common funding sources, and we talked about this earlier, are private, individual, or family donations, grants and foundations, and corporate contributions. So what else? And this is part of what we would be discussing in group. You can go back to that slide where I had a fuller list. But what other types of funding streams would be appropriate for your organization and your programs, your projects, and your activities? Can you come up with anything unique or new? And this might be something you want to take to your board, to your committees, to your volunteers, is what else could we be doing to bring money in? I encourage organizations to be thinking about fundraisers in a different way. I know it's quite common to go, well, if we need more money, we'll just put up another event. I would encourage you to look elsewhere. Events take a lot of time and a lot of resources. And what winds up happening is that every time an organization starts to get into a financial bind, and then they come up with another event, eventually that staff position or positions, how many ever people you have in your staff, start spending more and more and more of their time planning and coordinating events and less and less and less of their time working toward the mission. So I would encourage you to come up with different types of funding streams, ones that are not about taking staff time away from the mission work. If you can find funding streams that are in line with the mission, that is perfect. If you can find funding streams and availability that are raised through committee efforts, that's even better. So start thinking outside the box, start turning to some of the others in your organization to do some brainstorming around that. What income might be missing from your organization? How can we get it? And who in our organization is in the best position to bring in that money? Okay, so now we're talking about growing the business. As we're talking about bringing in those different pieces of income and where they might be coming from, it's good to have an understanding of your business model. What is your company's core strategy for profitability? So speaking of new and unique types of funding and profitability for your organization, the next few slides have been included compliments of Jane Bowling Wilson and the Northern Piedmont Community Foundation. So first of all, you will hear me say a lot, your business is as opposed to nonprofit, because that's what a nonprofit is. The first thing that you do when you form a nonprofit organization in the state of Virginia is you go to the Virginia SCC website and you set up a corporation. It is literally step one. You're forming a business. And I want every nonprofit leader to think that way, to be thinking about their organization as a business. So you will hear me say business a lot. I know people used to correct me. They would say, but I don't own a business. I run a nonprofit. It's the same thing. Really, there are very little differences. And I want you to get used to thinking about your organization like a business. So you're basically a small business and you share common concerns and issues with entrepreneurs. The typical entrepreneur starts a business with one particular skill or passion, and you're the lead of your organization because your skill is serving your community. That's your passion. That's what brings you to do this type of work. It's very common. I see very, very few nonprofit leaders who aren't passionate about serving the community and making the world a better place. So just like an entrepreneur, if you don't learn how to adopt a profitable business model and business practices, you won't be able to sustain your organization for very long. The goal is to teach your organization how to operate like a successful, profitable business so that it runs like a well-oiled machine, thereby giving you more time to be able to spend on your mission, that skill and passion that drives you and energizes you. So remember all the way back to the last slide in activity, and we were talking about all the different ways that you can make income, and hopefully a way that you can make income that doesn't take staff time away from serving the mission. And so one of the things that I found while I was running a Main Street program in Virginia is that community foundations are the hidden gem of every community. So there's one in almost every region of Virginia. I used to say every region, then I found out there's a couple places that they just don't go. But for the majority of you, there's a community foundation that serves your region. And if you don't know about them already, I urge you to figure out which community foundation serves where you are and reach out to them because they have so many resources for the community. So when I was in Virginia running a Main Street program, the Northern Piedmont Community Foundation was our local community foundation. And Jane is the current executive director there. So she sent a few slides to let me know about the funds that they have. And this is something, I mean, not all of these will be part of what you can do with them, but some of them are, and they're really interesting. So the 5 funding options that you see here, there's an organizational fund. Nonprofit organizations can create an organizational endowment fund to protect charitable dollars and provide a stable, predictable source of income for the organization. Such funds can provide annual support for the organization. A donor advised fund. So the first one you can create. You can create that endowment fund. The second one you cannot, but you can be part of it. It's a donor advised fund. It offers maximum flexibility because you can add to your fund as a donor. Recommend grants from your fund at any time and support multiple nonprofits. So this would be one where you want the community foundation to know who you are, and you want to partner with them, because what you want is when they have donor advised funds for people who are looking for nonprofit organizations in their community to support, you're going to want that person at the community foundation to say, hey, we've got this great organization that protects our downtown through historic preservation, economic opportunities. So you're going to want the people at your community foundation to be able to explain your organization to their donors, especially to the ones who have these funds where they can allot money anytime they choose in one direction or another in your community. Then you've got the Field of Interest Fund. These funds focus on a broad area of interest. Donors select these field of interest funds to support areas of interest such as the arts, childcare, or environmental issues. So you're going to need to talk to the community foundation and find out, do they have a field of interest that your organization would fit into? Do they have one for historic preservation? Do they have one for, small businesses, perhaps, because you support the small businesses there? Do they have one for, I'm trying to think, like historic preservation, economic development? I don't know if they would have that as a field of interest, but find out where you fit in. Can you put our organization in these particular fields of interest so that when there's funding there, we might be able to get part of it. The designated fund allows you to choose a charitable group to benefit from your fund. This type of fund ensures that the organization you select will receive support regularly over a long period of time. So the designated fund, this would be for your big, planned gifts and estate funds. This is, it's more like the donor advised fund, but it's a little bit of a partnership between a major donor and a particular organization. And then you have the scholarship fund. These are often created in memory of someone and can be used to support a variety of educational opportunities. So that one probably likely has very little to do with your type of organization. So here's a little bit more about the Northern Piedmont Community Foundation in their own words, and from their own website. And not all community foundations are the same, but this information probably applies to a lot of them. So the Northern Piedmont Community Foundation began in December 2000 when 9 concerned citizens from Virginia's Piedmont region were searching for solutions to the charitable needs of Culpeper, Fauquier, Madison, and Rappahannock counties. With modest beginnings, our funds have grown to over $15 million in support of local charities, scholarships, and community need in our Northern Piedmont region. We host the annual Give Local Piedmont campaign on the first Tuesday each May. This program connects our communities, increases awareness of our nonprofits, and incentivizes giving. Our community's 7-year total is over 5.8 million. I'm not sure what that is today. These slides are actually pre-pandemic. So hopefully they've raised a lot more. I know that Northern Piedmont or Give Local Piedmont is still happening. A community foundation connects people with causes they care about: human needs, education, environment, arts, or any other area of concern. Our foundation is one of 30 community foundations throughout Virginia. Each organization manages gifts through funds from all walks of life and uses them to benefit a specific geographic region. Because of generous donors, we can award grants to nonprofits, scholarships to students, and in the process, strengthen the core of our communities. Northern Piedmont Community Foundation supports individuals through scholarships for both college and credential educational opportunities. Nonprofits in our region have various needs that NPCF supports through donor gifts and community grants: replacing a roof on a shelter, supporting a position that tracks ER overuse, preventing pediatric periodontal disease, creating options for families struggling with abuse, and reaching young and older populations through music therapy are all causes we've contributed to. The foundation continues to fund innovative projects that meet the changing needs of our communities. And then there's a sixth fund created by nonprofits who are interested in growing their assets. So this is something that I think would be of particular interest to you. Like I said, this is the Northern Piedmont Community Foundation. I read the counties that they cover, but hopefully your community foundation has something similar to this as well. Each fund opens with $10,000. Funds are pooled and invested with funds under management, which right now, or back then, when the slide was created, they had $23 million of funds under management. Northern Piedmont Community Foundation's benchmark for return is 6.5%. Nonprofits can only grant to themselves from an organizational fund. The goal of the organizational fund is to have another organization manage the investment, returns, and accounting, which is what NPCF does, and your organization grows their assets. Our funds are managed by 3 different investment companies with oversight through an NPCF investment committee. So this is super exciting to me as a nonprofit management consultant. This is a really good investment opportunity for you. When you're getting your planning so accurate that you can forecast the proceeds, the revenues that you're going to have at the end of the year, the reserves, then you can plan to set that aside. When you get to $10,000, you can open one of these accounts with the Northern Piedmont Community Foundation. They have a benchmark for return at 6.5%. So right now, interest rates everywhere else stink, and the stock market is unpredictable. This is a really good, safe place for you to invest your money and grow it. Set it aside. Let's say there's a project you want to do that you know is going to be, 3 years from now, 5 years from now, and you want to set that money aside so it doesn't sit in your general funds where you're tempted to spend it on something else. Put it there. Now, I don't think there's a requirement for how long it has to sit there, but like it says there, like you grant the money to yourself. So if in 3 years you have a big project that's going to cost 10 grand, well, by then your investment has grown and you've got more than 10 grand in there. You can take the 10 grand out and grant it to yourself for a special project that you have going on. That special project could be hiring another person. It could be anything. But this is a really great way for you to set that money aside. Like I said, I'm sure for most of you, the Northern Piedmont Community Foundation isn't the foundation for you, but look at your region. There are several, what did it say, 20, 30 of them across the state. Hopefully you're in a region that's covered by one of those. Okay, so we're going to get back to this. This was the slide I showed you before I went into my thing about the Northern Piedmont Community Foundation. Sorry, my throat's getting a little dry. So we're talking about your business model, your company's core strategy for profitability. So now we're going to go to the next handout. Let's see if I can show you this one. Go back here. Okay, so beyond the variance sheet, the next handout looks like this, and it says defining your business model through profitability. So now it's time to start talking about the size of each of your current pieces of the pie. As we all know, size matters. So are your current income streams an appropriate size? Do they fully fund what they're meant to? For example, you have a program that costs 10,000 and a grant for 10,000, and that's perfect. But most of your income streams won't line up quite so directly. Let's talk more about your business model. How is your company going to be profitable? And how profitable is it going to be? So I'm going to apologize now. This is not everybody's cup of tea, but we're going to be doing some math. So go ahead and pull out that handout if you had it and take a look. These are actually, I know they just look like words, but these are actually ratios. It's math. The current ratio is defined as your current assets divided by your current liabilities. So if you're a balance sheet person, like I mentioned earlier, excuse me, the current ratio is for you because you will already have your current assets and your current liabilities already defined on that balance sheet. Then the reliance ratio is the amount of the largest income stream divided by the total amount of income, or your total income. The single reliance ratio is the single largest income source divided by your total income. So the current ratio is meant to help you evaluate your organization's level of liquidity. How well would your organization be able to pay its current obligations right now? And by current, we mean obligations occurring within the next year. A 2 and up is great. 1 and below is worrisome. Would you be able to pay off your loans? Are you struggling to even pay off monthly bills? Where do you stand? So when we take our current assets and divide by our current liabilities, realistically, what you're looking for here, let's say your current asset. So what goes into that? Do you own the building that your office is in, or any of the buildings in the downtown? Is there real estate? That's an asset. Any was it accounts receivable, people who owe you money right now, that is an asset. The money you have in your bank is an asset. If you had one of those funds with the community foundation, that money is an asset as well. So now the current liabilities, is any debt that you owe within the next year, rent you have to pay, real estate, if there's a mortgage, if you have a loan, any accounts payable, what types of things you have to pay off in the next year. So realistically, what you're looking at is if everybody called in every loan and everything you owe over the next year right now, and you had to use all of the assets that you have, what would be left? That's what that current ratio is telling you. So if at the end of the day, at the end of the week, you had to pay off every single liability right now, what would be left to your organization? Would it still be standing? Would you be in debt? Would you be just done? Would you be flatlined right at zero, the balance? Because what we want to know is that if I had to pay off everything, I still have twice that. So like I said, if you come out with a 2 or above, you're pretty golden. So if you could pay off all of your liabilities, everything you owed, and you'd still had twice that much left over, you're in pretty good position. If your current assets would all have to be sold off and liquidated to cover your liabilities, and then that would be a 1. You know what I mean? If all of your assets and all of your liabilities equal each other, then you're at a 1. And what that means is, yeah, you could do it. You could pay off all those liabilities, but at the end of it, you won't be left with any assets either. Now we're in trouble. So you'll still be standing, but it's just going to take one little breeze to knock you over. Now, if you had to liquidate all of your assets to pay off all of your liabilities and it still didn't cover everything, then you're really in trouble. So when we do that ratio, what we're looking for is, what position are we in right now? How stable are we financially? And you want to know that you're in a good position. So like I said, if you do this exercise and you've got less than a 1 or a 1, you need to worry. The closer you get to 2, the better off you are. If you surpass 2, you're doing really well. Now, the reliance ratios, these will help you understand how reliant your organization is on one particular income stream. And so when we say income stream, I don't mean, your town or XYZ Foundation. It's one income stream. So you're going to package them together into categories. It's a category of income. What is your largest income stream? Is it government? Is it grants? Is it private contributions? That's an income stream. So you're going to take your largest income stream, the amount of money you get from that income category in a year, and divide it by your total income. So you find out how reliant you are on that particular income stream. And then the single reliance ratio is how reliant are you on one particular income source. So the income stream we said is a category. One income source would be something in that category. So if we're looking at grants and you're getting a grant from the community foundation would be an example of an income source. And so what we're looking for is it's about stability. It's also about diversity of your funding. If you talk to any financial manager, they're going to tell you, of course, never put all your eggs in one basket, right? So it's that sort of thing. If, let's say, and I know this is common, let's say 50% of your total income is coming from your town, that's the single reliance ratio. So their single income source, your single largest income source is the town at 50% of your total income. That's huge. That means if something happens to your town government and they're not able to fund you, or maybe it's a different mayor, town council, or town manager now, and they just don't get you or don't like you, and they decide just to not fund you next year, that's 50% of your annual income that's out the window. So I'm not saying that would ever happen, but it does make you really vulnerable. So that's what we're looking at here, is how vulnerable are you? What risk is there to your organization because you're weighing too heavily on a particular income stream or a particular income source? I need to go back to the slideshow. Sorry, I forgot I wasn't there. Okay. So now we're talking about gauging risk, as I said before. And this is another handout that you should have. It looks just like what you see on this slide. It's same woman, glasses, she's playing life-size Jenga. Let me pull that up for you now. Okay. So now we're gauging risk. Oops. Now that you understand the reliance ratios, it's time to decide what the risk is with being reliant on any particular income stream or funder. It's okay to be 50% reliant on one funder if you're guaranteed those funds year after year, but it's not okay to be heavily reliant on one particular source that's a one-time thing or one that could disappear tomorrow. So when we're looking at this slide now, I've come up with this, I said COVID. Looking at this chart, I totally made this up. This is fake, just to give you an example. So I have in here 4 different funding sources, and you can see the single reliance. So this is about an income source, not an income stream. So now we're looking at how reliant we are on very individual income sources for our organization. So you can see here, I have a grant from the Path Foundation as a funding source at 3% of our annual budget, which is $10,000. I see Fauquier County as a funding source at 10% of our income and $30,000. We have corporate sponsors that are 12% of our income or $36,000. And then we have a grant from Foundation B at 15% of our annual income at $45,000. So in looking at each one, what we want to do here is, okay, again, we're going to go along with what we did with the variance report, which is what risks are we okay with? How significant is significant to us? Where do we really want to spend our time analyzing? What do we want to look at? Do we want to look at everything? Sometimes, like I said, you can get lost in the weeds if you're looking at everything. Not everything is significant. So pick and choose, like what percentage of reliance are we okay with and which ones do we really want to evaluate? And it's dependent because you might, as you'll see in a minute, you might be at greater risk for losing something that's at 3% than you are something that's at 50%. So let's go through these examples here. We see the PATH grant is 3% of our annual income. It's $10,000. What is the risk to this source? And this is something that as a group in your organization, you're going to have to decide and talk about, because somebody might see a risk differently than you do. So the risk to this source is continued funding once it's not a new program, which I actually ran into one time, not with PATH, but a different grant that I had was for starting new things, for implementing new programs and testing them out. Which is great. I mean, it's wonderful because it gave me the funding to start a new program. The problem is if it's a program that's worth funding and keeping, you couldn't get it a second year because it was only for new ideas. And once you've done it once, it's not new anymore. So you knew, okay, I have this money now. And if this program really works, year two, I need to find different funding. So that is part of what I put into this chart here under this grant. The risk is that in year two, this grant is not available. So budget changes as a result. What are we going to do because of this risk? We're going to leverage for matching funds and additional grants. So basically what we're going to do is we're going to take the success from year one, and we're going to leverage the fact that it was funded as a great idea that somebody believed in to get a different grant for next year. And we know we have to do that. We'll have to figure out what the budget for year two is for that particular program and use the grant and information and data that we tracked in year one to attract new funders. The funding source, Fauquier County, which is 10% of the budget. The risk to that source is the COVID-19 recovery funding requests by numerous organizations and companies, which was a real thing. I don't know how real right now, but a couple of years ago, everybody's government funding was at a risk because so many businesses and nonprofits needed much more money to help them recover through COVID. And so it really wasn't about, well, do they like us? Do they believe in us? Do they want to fund us? No, it was really about how much funding is available because now they're having to support so many organizations in the area. So it's a risk now. Are we going to see as much money from the county because of all these COVID recovery requests that are being received? So what budget changes are we going to make as a result of this risk? And the decision with this organization was none. We're not going to change our budget because of this. What we are going to do is we're going to make a stronger case for continued funding and relate it to COVID recovery efforts. So instead of changing our budget and expecting less, we're just going to make a stronger case to the county that says, look, you've been supporting us for years and we appreciate it, but we know you support us because we support the community. So instead of pulling our funds to give to others, please continue funding us at the same level so that we can help make a greater impact in our community during this difficult time because we already support so many of the organizations and businesses in this area here. Will it work? Who knows? But that was the decision this organization made. There's always a risk. We just have to identify it and do the best we can to support our annual budget. So moving along here, we see corporate sponsorships, our funding source at 12% of our annual budget. What are the risks to this source? Excuse me. Supply chain shortages and material costs that increase material cost increases continue. So this is definitely something that we've seen through the pandemic as well. Things like building supplies and groceries and other things that, one day they're there and the next day you can't find them to save your life. And some of our corporate sponsors are experiencing those shortages, which means they're having a difficult time with their business. Their supplies are either in short supply or maybe just have skyrocketed in cost. And so our corporate sponsorships we don't know which businesses are going to still have the money to support us. So budget changes as a result, we're going to forecast 2% decrease in this category. And maybe what we're going to do is we're going to understand that maybe 20% of the businesses that supported us before are either going to not support us this year or support us at a lower level. And maybe we can have conversations with the businesses that are doing well, that haven't been so affected by supply chain shortages, and say, hey, look, this is affecting some of our sponsorships. So, we're seeing less and less. We know you're not experiencing the same hardship. Would you be able to contribute more this year so that our loss is only 2%? And then we have Foundation B that gives us a grant that is 15% of our annual budget. And what is the risk to that source? Well, our funded program is aligned with that foundation's goals. So there's very little risk. We feel like that program that we're running and this foundation are just so in love with each other. They should get married. It's just a perfect fit. And budget changes. So here's where I want you to be careful and start really thinking. While you might be thinking, well, then there's very little risk, we don't need to change a thing, I want you to understand that sometimes risk works in the opposite way. It's an opportunity. So it isn't about what risks there are and how we should decrease the budget or our expectations. Sometimes you find opportunities that you can leverage, that you can take advantage of. And this is one of them. This program and this foundation that gives us money are so well aligned that we're going to apply for increased funding to cover the funding and the program that we might be losing with PATH. We think this organization might be willing to fund both programs, or maybe it's really one program and funding comes from two places for it. But either way, we see this as an opportunity. We know we're going to lose 3% with that PATH grant that can't continue. And even if they won't cover that, maybe they love us so much, they'll give us more so that the program they are funding can grow, or so that we can start a different program. We want to build that relationship. So this is part of it as well. I know we're talking mostly about money, but also be thinking about that. It's a foundation, or even with the corporate sponsorships or the county. Be creating that relationship so that you can have these conversations and be completely open and honest. Hey, look, we're going to lose this thing, and we really think that your foundation is a perfect fit with us, that we're so aligned. We really want to continue this relationship. We want to foster it. We want to see it grow. We want to be able to do mutual things together. We want to be able to come back to you time and time again, so that we're both so excited about the things we're implementing in this community. And, maybe someday we'll get to the partnership level, but anyway, we want to keep this relationship going in a positive direction. So use all of these things to the best that you can with opportunities. Leverage everywhere that you can. If you see something that you're like, well, there's really no risk of this going away, then maybe it's time to ask for more money. Be bold, be brave, be excited, dream about what your organization could do if you had more money. What if you had reserves at the end of every year? What if we got to the end of that variance report and we weren't looking at negative numbers and trying to figure out where that money is going to come from? So be thinking along those lines. What would you do if you had all that money? What else could you grow? Could you invest in? Could you do in your downtown? So as you're looking at risk, think about it this way. While risk has a negative connotation to some, the opposite of risk, which I know we don't always think of it this way. Sometimes risk is positive, sometimes it's negative, and sometimes that risk is really packaged as an opportunity waiting for you. So think of it that way. Oh, sorry, I'm still in handouts. Let's go back to the slideshow. All right. So now we have another group activity here. This is a place that you might want to pause and do this activity with the people in your own organization. We're talking about incentives. What can you offer to ensure continued support? So as we're talking about those opportunities, we want to know, what are some of the best practices? What are some of the ways that you can get people to support you more indefinitely so that there's less question of risk and more opportunities coming to you? So this one was something we were going to do as a full group, not breaking out into smaller groups. So get everybody and grab some markers or whiteboard, whatever you have available to you, and really just brainstorm together. Let's talk about what incentives you can offer that will help you gain buy-in from donors and funders, and or help you retain donors and funders. So here's an example. When I was running a group in Virginia, we had that Christmas event that I told you about. It was called Gumdrop Square. So instead of standing in line in the freezing cold for hours to visit Santa, people used to ask me all the time if there was a way to skip the line, which, of course, I was like, no, of course, I can't, these people were waiting 2 hours. I can't just throw you in the front. But then I realized that it was an opportunity for me, and I created a private VIP party with Santa. And for a $100 donation to our organization, your family would receive an invitation to a private party where we had a professional photographer taking pictures of Santa, not just a volunteer, but an actual pro. We had elves who would help the kids shop in Santa's secret shop. We had hot cocoa, cookies and snacks, and no line. It was just a private party for your family and the other families who donated $100. So, I mean, there might have been 30, 40, 50 people over the course of that day that we did, but it wasn't anything like stand out in the freezing cold. And so it was huge. It brought in new donors and didn't create a lot of extra work for the staff, which was just me at the time. Realistically, all I had to do was get a couple different volunteers than I had on the weekends. The place was already decorated and ready to go and completely empty during the week. I just had to find an afternoon or an evening and bring everybody together, get a couple board members to come in to chit chat, play some Christmas music. It was really just a few extra hours of my time where the event was already set up and ready to go. So it cost us very little, but it brought in extra support. So at this point, if you have some people that you can do this with, I would say pause the video and get together and think about new ways that you can bring in new donors and supporters without much effort, and a way that you can incentivize your current donors and contributors. What can we offer to get them to up their support? And think about all the different things that you can do. I mean, I know you've all seen the SPCA and St. Jude's and all those. Act now and we'll send you this tote bag or this mug or this t-shirt. There's stuff like that. But there's so many other more clever, creative ways. So sit there and talk about it. What can you do? What type of incentives can you offer? It doesn't always have to be swag or some sort of gift. But what other incentives can you offer? Okay. So now we're talking about leading critical funding conversations. So it's great to be able to do and understand all that we've just talked about. But what if you leave tomorrow? And when I say that, I'm talking mostly to the executive directors, but also to the board directors, board presidents. Who else will be able to do this? And what if you stay? Who else should be involved and support and help you implement changes? You need to be able to communicate the funding plan to the board and other staff to ensure proper changes are made and that the organization is making plans for sustainability, for success, for growth. So why? Why do we have these funding conversations? Why are we bringing people in? And when we bring people in, it should be your board and the rest of your staff, if it isn't just you, but also possibly your committee members, all the people who are going to be doing a lot of the heavy lifting, making decisions. Why are we doing this? Well, number one, because we need to share institutional knowledge. And this is something that I recognize is really important, especially as organizations with a staff of one, just the executive director, no one else, because most of your board and committee members are not there on a day-to-day basis. They don't know every single thing you're doing. Heck, they don't even know where some of your files are kept, most likely. And it's, I'm speaking mostly about myself here as an executive director, it was all in my head. It was all up there. I knew how to do everything. I knew where everything was. Nobody else needed anything because it was all me and it was up to me. The problem with that is you get hit by a bus tomorrow, you get COVID in your quarantine tomorrow. You walk out the door tomorrow. Who else in the organization knows what to do? Now we can be stinky and we can go, well, if I go away tomorrow, then if nobody else already knows, then the whole organization deserves to fall down. But we don't want that to happen. Hopefully you worked really hard and you recognize that this organization you work for is astounding and amazing and does such a great job for your downtown. And you're going to want it to continue with or without you. So we need everybody in the organization to know Um, it's one of those things. I know it's hard to envision and to feel, but you want to be replaceable. You want that organization to still be standing on its feet after you go. If something happens to you, all that hard work you've done, you want it to be able to continue. So you need to share all the things that are in your head. We also need to share it because we need gain in and organizational buy in. If the people in our group don't understand what's going on, they can't take ownership of it. They can't step in. They can't really help. So we want them to be able to buy into it. We want them to understand what's happening and what's going on and what direction we're going in so that they feel more of it, so that they can help and so they can want to do more. You have more brains for brainstorming. And while I'm sure your brain is absolutely fantastic, um, it's one brain. So many more people have such a different outlook and perspective than just you. So, sometimes we have our blinders on, sometimes we can't see the forest for the trees. We're so overworked. Bring in a bunch of people and gain all those different perspectives. You'd be amazed at some of the ideas that people can do, especially you've got people who have different skills, people who have different vocations, people of different ages, people of different nationalities. I mean, so much diversity on your board can bring you so many new great ideas. And so that's what some of these conversations are about as well. And more hands for implementation. Like I said, when they understand more, when there's more organizational buy-in, you get more people ready to do the heavy lifting with you. So what is it we're talking about in these conversations? Well, we're going to go through the financial statements, the balance sheet, if you can stomach it, the business model and the ratios that we talked about, that variance chart. We want to go through all of those things and talk about them. What is the risk level, that the variance level that people in your organization are comfortable with? What things are we really going to examine? How are we going to find the answers? And how does this affect our planning going forward? And the risk assessment chart. So that is what we were talking about, those 4 funding sources that I put in the chart with the woman who's playing that life-size Jenga look like. We want to come up with that for ourselves. Let's look at our funding sources and decide what are the risks that we need to discuss and what are we going to do about them? Which risks are really opportunities? Ideas for improvement. As you look especially at the variance report, how does seeing those variances from the previous fiscal year take shape as far as our planning for the next fiscal year goes? How are we going to improve that so that next year that variance report is a lot tighter? How are we going to make sure that our planning, our budgeting, and what happens in actuality are so closely aligned that we don't have to have these discussions every year? We can just be talking about opportunities and moving forward. So let's make sure that we have that planning process planned a little more carefully, and be really cognizant of it throughout the year. Here's what we're planning on making. And maybe when you get to that Christmas event and there's that day where the roads are so icy, you're going to close the event, and that's going to make that income slide a little bit. What can we do to make up for that? How are we going to make up for the fact that everybody's now home, not at the Christmas event, and we still need donations and sales for that? Can we do something virtually instead? Can we extend it an extra day to make up for it? How are we going to gain that income back instead of just waiting to the end of the year and seeing it as, what was it, 22% less than expected? And then confirm your risk comfort levels and assess your risks. Like I said, create that comfort level that you guys are good with, and then talk about all the other risks. So go back through all of the assessments and the math that you've done here with me today and talk about the shifts in funding streams that you feel are necessary going forward. There may be some you decide just aren't worth it, and maybe some new things that you want to replace them. Show everybody in your organization who's making decisions and doing the heavy lifting, show them the reliance ratios. Do they agree with the levels that make you concerned? Do they share your observations regarding the risks and how to mitigate them? And always come with solutions and ideas. No one likes someone who just comes with problems, so make sure you've thought this through. What are some solutions and ideas that you can propose? What are some creative funding solutions? Some of them might include leveraging current funding streams as matching funds for grants, creating a new fundraiser for covering general funds and indirect costs, soliciting major donors who are connected to your mission. Talk to the community foundation and see if they can connect you. Creating a sponsorship opportunity for a local corporation to gain exposure in relation to one of your programs. And talk about the things that you have difficulty bringing up with your committee or board members. Maybe it's something that you want to talk to someone else outside of your organization with. Here are some things that I have to bring up in these critical funding conversations with my board, and they're not going to be happy about it. Maybe you need a sounding board, someone you can practice on, someone who can help you decide how to have that conversation in the most constructive way. So, the mission impact. We're talking about your mission impact versus financial sustainability. So we're going to do this, or we did do this in person as an activity together, but this is something that you can do with your individual organization, your committees, to help them see where you're coming from in items you want to discuss with them to get them more involved in the process. So there is one more handout that you're going to take a look at. To me, it looks a little bit like a picture version of a SWOT analysis. I will share it with you here. So here you can see the impact sustainability matrix. Instead of strengths, opportunities, weaknesses, and threats, you have different labels. So pull out that handout, excuse me, if you haven't already. The 4 quadrants here. I'm going to start with the good. Top right-hand corner, you see the gold star. So, okay, let's look at the arrows first, the quadrants. You have financial sustainability. As you see, the arrow points to the right. So the closer you are to the right, the more sustainable this program or event or whatever you're evaluating, the better sustainability it provides for you financially. And then we have the mission impact with the arrow going upward. So the higher you get, the better this impacts your mission. And so really what we want is something all the way to the top and all the way to the right, which is the gold star. It is high mission impact and high financial sustainability. So these are, quote unquote, your gold star programs, events, projects. You want everything to be in that top right quadrant. So now if we look at the bottom right, we see the money bags. It has low mission impact, but high financial sustainability. These are, I'm going to say, some of the most questionable things you've ever seen. Some of the things that they feel really successful, but yet you still kind of feel bad about them. And you really, really, really don't know how to give them up, because there are things like, we had a Father's Day car show when I was first executive director of the organization I was with. Couldn't figure out why we were doing a Father's Day car show, because what happens on Father's Day in a downtown? Nothing. All the businesses are closed on Sundays, and definitely even more the businesses are closed because it's Father's Day Sunday. The only thing happening are a couple restaurants and church. And in the midst of all that, we have a car show. So you tell me, as Main Street leaders, what does a car show have to do with your mission of your organization? Especially when it's bringing people downtown while every single thing is closed. There is nothing to do. We are now in the way of all the churches and the church traffic and the church parking lots. The only way this related to us was that we were doing it in downtown. And I spoke with my board and I said, why do we have this thing? It's tons of work. It does make us money, and we could figure out how to leverage and make us more money. But why do we do it? And it turns out the previous executive director before me, her family loved car shows. So her parents decided that while they had a daughter who was in charge of downtown and could close streets, they should do this car show, and it would be money for the organization she was with. So I was like, okay, well, be that as it may, it really doesn't help our mission. It doesn't help our downtown. It was a really successful event. It got bigger and bigger each year, and we learned how to leverage it and make it more money, but it was just so much work. It didn't go in line with our mission. And so had the critical conversation with my board and found out there was another organization that was new, that had no signature event, who really, really loved the car show. So what we did is we partnered the next year. I ran the event and they shadowed. And then the following year, they ran the event and I shadowed. And then they took it over from there. And it was a really good partnership, and it was something that was really good for their organization. It just wasn't so good for ours, but it was hard. It was a difficult decision because it did bring us money every year, and we were learning how to leverage that and have it make us more money. Um, but the problem was I really needed to be spending more time working toward the mission, toward the things that I knew our Main Street program needed to be about, that I just didn't have time for in the face of all these events. Now, bear in mind too, this was one of about 8 events that I ran. So it wasn't like, well, we just don't have any other events that I can focus on. This was one of the ones that was just down there in that little bottom right-hand corner that was like, well, yeah, the money's nice, but we're spending a ton of time and we're not serving our mission while we're spending our time focused here. So that's my example there. Now, if we skip up there to the top left, you see the Purple Heart. This is high mission impact and low financial sustainability. So these are the ones also that you don't want to dump, because they're just where your heart is. You know you're serving your mission. You know you're doing the right thing for Main Street, for your downtown, for your organization. The problem is it just doesn't make you money. It's not a sustainable program, or project or event, whatever it is. It either just doesn't bring you much money, or maybe it loses money every year. Maybe it costs you more than it brings in. So then you want to have the discussion about it. And for all of these discussions, it is, can we move this thing closer to being a gold star or not? If we can't, then is it worth it? So the high emission but low financial sustainability, the question really is, can we find some better funding for this thing? Can it at least break even? Maybe it's just not a fundraiser, and that's okay. It's fine. Not everything you do has to make you money, but it can't just operate at a loss. So we need to figure out, is there a way that we can find the funding for this particular program or whatever it is? Can we even go from there? Can we turn this thing into something that makes us money? It's okay if it doesn't make us rich. It's not okay if it bleeds us dry, though. So we do need to be very careful about that. We want to make sure that that high mission impact stays intact, but that it allows us to be financially sustainable with our organization. And then we have the bottom left corner there, that sad little stop sign. The things that are down here are low mission impact and low financial sustainability. These are the things that we're doing that don't make our organization money, and they really don't align well with our mission. So these are, I would say, as you are evaluating with your organizational leaders, things that fall into that bottom left-hand corner, I would say somebody needs to be bold enough to say, how do we make this thing go away? This is a project, an event, a program that we have that is very, very unlikely to make it into a better corner of this matrix. So we need to stop right now. It is confusing people about our mission, about who we are, about why we're here, and it is not bringing us income. It is not allowing us to be financially sustainable. So have that conversation. Is it something you can just stop doing? Is it something you can give to another organization? How do we want to do this thing? But either way, we know over time, it needs to go away. It isn't likely to change or get better. So it just needs to go away. And that's a difficult thing to do. Obviously all of our gold stars, they're really easy. We just pat ourselves on the back. We celebrate these things. We share them out. We tell the world, easy as could be. The money bags and the Purple Heart are things that we have to have conversations about. How do we get this into a better place? If we're going to keep it, it needs to do better. It needs to perform better. It needs to be more aligned with our mission. It needs to allow us to be financially sustainable. If we can't move it, we have to decide, is it worth it to keep it? If it's never going to move toward being a gold star, do we still want to do it? And that's where those difficult conversations have to come in. And then, of course, your stop sign, I'm hoping that's not a difficult conversation. It's really just okay, we've evaluated now and we see this thing clearly. It just needs to go away. So we just need to figure out when and how. Hopefully that's not a really difficult conversation for your organization. All right, let's get back to the slideshow. Okay, so finishing off the funding plan now. I know we've taken a lot of side trips here, but your funding plan, you want to be something that is well written. I usually use the same template for my funding plans as I do for my strategic plans. It explains everything. Like I said, this is not the same as your budget. You're not looking at your bottom line. You're looking at all the places you're going to get money and how you're going to get them. So at this point, you should have, excuse me. At this point, you should have all the information, the math, the assessments that you need to create your organizational funding plan. And here's how. You're going to review the budgets and adjust them as needed. You're going to add or adjust funding streams as needed. Hopefully you found a few more ways you can make some money that you can put in there. You're going to match your funding streams to your programs and activities. So here's where we're going to start aligning things. You're going to need to take your work plans out and all the budgets for each one of those projects and programs that you're going to be doing through your committees over the next year. And you're going to make sure that you have the funding that needs to be provided so that all of those activities can get carried out. Obviously, there's going to be more than just those activities. You're going to have any administrative costs, overhead. Also, please figure out your best guess at what you're going to have in reserves and make a plan for what you're going to do with them. How are you going to invest them? How is that money going to grow and work for you? So you're going to look for your profit and reserves. Hopefully, it also means that your funding pie is larger than your program pie, if you will. So you'll know that you've done a good job with bringing in more money than you expect to spend. I usually enjoy making that funding plan part graphic and part narrative. As I said, you have so many brains in your organization and they work in different ways. So some people want to see something very image and graphic like, something that gives them a snapshot that's more about image and pictures and a quick impression of what's happening. And then there's some of us like me, a little more on the nerdy side, need all the words. So the part narrative that explains everything. And be really specific about how much money is coming from each funding stream, who is responsible for securing it, what time of year it's expected, any alternative plans, and how the funding will be applied. So I put in there what time of year it's expected because a lot of times that matters greatly. If you think about your year, you know when you're going to need to spend more money. So typically, the average organization or business is spending the same amount month after month. You know, you've got utilities, you've got overhead, you've got payroll, you've got insurances, like those things just keep recurring. But then all of a sudden you've got this huge event you have to do, and you know you're going to need $10,000 to get this event set up and rolling. And so you're going to need a big lump sum that is sitting in your bank account at that time of year because that's when you're going to be spending a ton, a lot more than you would just normally on your average month at another time of the year. So you're going to need to make sure by the time you get to that spot in your year, you've got that big amount set aside in the bank. So make sure that that's part of the funding plan, that we need to raise this much money by this time because I need a big chunk right then and there. Also, like I said, in that plan, who's responsible for securing it? So 2 things to note about that. It can't always be your executive director. There should be committees and boards doing things. And also, who is responsible for securing it does not mean this person is responsible for going out and getting that money. It means this person is responsible for making sure that money is gotten. Hopefully that makes sense. There's a differentiation there. So if I say to you, board chairman, you're responsible for $10,000 being in the bank by September, does not mean you, board chairman, go out ask people for money, gather $10,000 and put it in the bank account. It can be that if you want it to be, but you as board chairman, if I say this thing is yours, it just means you need to figure out how that's going to happen and oversee it. So maybe that is you as a board chairman going to the event committee or the fundraising committee or whatever you've got, or maybe other board members, and saying, okay, you know what we're going to do? There's 10 of us, each one of us go find $1,000. Let's put it in this pot. And there it is. So either way, you're responsible for making sure it happens, not necessarily for personally carrying it all out. But I do have all of those things in the funding plans that I create, because like I said, it can't just be the executive director. There are so many other volunteers, committee members, board members in the organization that one person can't do everything. So that funding plan is going to be about how that money is being applied, which income stream it's coming from, how we're going to get it, who we're going to get it from, who's responsible for it, during what time of the year. It's a step-by-step roadmap, basically, to every dollar you're going to bring in. It leaves little questions. It might also, it leaves little to question, but it should also have alternatives. As I said there, what if we're counting on this grant to come in to run this program and we get denied the grant? Are we still running the program? Is the program canceled? Where else could that money be coming from? If, let's say, that supply chain doesn't clear up and we have fewer corporate sponsors than we expected, where else can that money be coming from? So we need to be looking at that. How are we going to make up for any of those variances that we're not expecting during the year? All right, so that is it for my part of the presentation. Because we're not live, this is one of the things, if you have questions, you can email me, you can call me, you can text me. I'm happy to answer anything. Hopefully I explained everything through this webinar well enough for you to understand. But if there's more information that you need or another way that I can help you, please get in touch with me. Take a screenshot here. You can save this. And I really appreciate you spending all this time with me. I know this is quite long. And also from DHCD and Virginia Main Street, thank you. And thank everyone for taking the time out of your day to participate. Hopefully you're sharing this with others in your organization. So thank you to all of them. And following the webinar, training evaluation will be emailed to you. I don't know if that's true if you're watching this on video, but if you'd like to say a few words to Virginia Main Street or myself about the performance and what you learned throughout this, I know it would be greatly appreciated. I'd love to get your feedback. Here you see the Community Vitality Office and Virginia Main Street staff. Not only their names, these are links here to get in touch with them if you like. I think the links still work through this. I guess it doesn't show me, but I think you can probably click here, or you can go to the Virginia Main Street website, and I know you can see the same staff members. You see the web domains there under the Main Street logo. And more staff over on the right-hand side. Please get in touch if you have questions, if there's anything that they can do for you. And economic development and community vitality, here's the greater statewide staff. And again, thank you so much. I really appreciate all of your time today. Hopefully you got a great deal out of this. And